Hi, everyone. I'm Mark Sir, Product Manager at Saving for College. And on behalf of the whole team here, I'd like to welcome you to today's 529 Day celebration. Each May, states across the country recognize 529 Day with various giveaways and contests, which we've listed in an article on our site. We'll drop the link in the chat right now so you can see how your state's celebrating. At Saving for College, we mark the occasion by bringing you an expert panel to answer your college savings questions. So thank you to all of you who've included questions during the registration, and we welcome you all to ask questions using the Zoom Q&A function. We'll do our best to cover as many questions as possible, but if we're not able to get to yours, you can find more resources on savingforcollege.com. Today, we're joined by two gentlemen with vast experience helping families save for college, Joe Messenger and Roger Young. Roger is a thought leadership director with T. Rowe Price, where he helps develop the firm's perspective on personal finance topics, including college savings, financial aid, and student loans. Welcome, Roger, to your first Saving for College webinar.
Thanks, Mark. Glad to be here.
Joe's the co-founder of College Aid Pro, where he's on a mission to end the student loan crisis one family at a time. College Aid Pro's award-winning software helps families and financial advisors plan for all 4 years of college costs. And Joe's a staple of our webinar series, so we're thrilled to welcome him back today.
Thanks, Mark.
Before I start asking the panel your questions, I have a question for the audience. We'd like to get a sense, of where you guys are in the savings process. So we'll put that poll out in the field. The question is, have you started saving using a 529 plan? So I'll give everybody a moment to answer that poll question as it comes up. And we'll take a look at the results. Just give it one moment.
You know what? I can't vote. Oh, all right. That's all right. Don't want to skew things.
All right, we can go ahead and close the poll there and we can take a look at the results. Oh, wow, that's fantastic. So over half of our audience has started saving with a 529 plan, and a really strong majority there. It looks like about 75% have started saving, at all, whether it be with a 529 plan or not. So that's really fantastic. And I think whether you're saving already or not, if you're saving with a 529 plan, that's really great. But a question a lot of families have, especially with really high sticker prices for tuition and constantly growing. I went and looked at our college savings calculator, and we'll drop a link there in the chat so you could take a look at that. But for a newborn right now, we're projecting over $300,000 in total private university costs, in 18 years. And so a question I'd like to pose to both of the panelists is, how do these families set a realistic college savings goal? So Roger, I'll let you start.
Sure, we've done a lot of work on this at T. Rowe Price. It depends a lot on your individual circumstances, but let's just take a simple example of a family that wants to send someone to a public in-state college, including room and board, living on campus, and those costs today are probably in the the low 20s of thousands of dollars per year. By the time that student gets to college, if it's a newborn today, that could be well over $200,000. We tend to recommend that you look at all different sources of funding, and on average, people tend to fund about half or maybe a little more of college with savings and income from the parents. So if you're aiming for that, a simple rule of thumb might be aim for $250 per month. And with some assumptions on inflation and returns, that could get you to fund about half of that sticker cost, with the rest being filled by grants, scholarships, reasonable amounts of loans, maybe some work or other sources, for the student. For some people, they'll say, okay, $250, that's reasonable, and we can go ahead and do that. Other people are going to say that's going to be a stretch, especially with all of the other expenses that you get hit with as a new parent. So, don't let that $250 per month number discourage you. Get started with what you can, and then make adjustments, over time if possible. For example, when you're no longer paying for daycare or what have you, there are opportunities to bump that up over time.
Excellent. And Joe, maybe you'd like to share some of your thoughts. I know you know a whole lot about financial aid and available scholarships, so that might be able to give some additional context for families looking at a massive sticker price, and getting very concerned.
Yeah, that's a great perspective by Roger. And the one thing is get started. The best way to pay for college is to save. But when you do a calculator and it says you need to save $900 a month, like don't freak out. Because when you get there, the way college is actually paid for, what we know is about over 30% is paid for through grants and scholarships. So that's good news. And then when we look at the sticker price of the private colleges, I just saw the study just came out yesterday that on average, private institutions were discounting their tuition 54.9%. I'll say that again, private institutions discounting tuition 54.9%. So the sticker price is part of it. Just understand saving for the full cost is usually pretty intimidating, but getting started with something like a $250 and just understanding like a third of college is probably going to be paid for from other people's money. If you can, as a parent, thinking in terms of if you can save for a third and you can cash flow a third and you can have minimal student loans to make up that other third, that's a way a lot of families are paying for college today. Save what you can, cash flow there, and try to mitigate student loans. So hopefully that's helpful.
Excellent.
One quick thing I'll add though, if you don't mind, sorry. The third is not a bad way to think of it. I would just say that third from cash flow can be a challenge, right? Imagine you're spending 18 years before college to get to that 1/3 from savings to cover another third with cash flow during college might be a little tough. That's why we recommend getting to 50%. Again, every family is going to be different. Depends on public, private, your priorities, how much you want the kid to chip in. So, fine tune it for your own situation.
Yeah. And I would say too, like we're on a 529 webinar, but you got to balance these things. Current lifestyle is the one thing you can control somewhat, but you do need to make sure you're balancing it with your retirement savings, make sure that's on track too. Make sure you're matching all your retirement plans at work. That's something I'm sure Roger and I would both agree to. So when you're looking at college, you got to balance it, but do make sure that you're also not losing sight of how to balance it with your retirement goals.
That's an excellent
Absolutely.
point. And so, so far we've been talking mostly in terms of very young children, right, and families that have a decent runway to grow their savings through market returns. Now, what about parents who are saving for older children? This is a common question we saw, in the registration, whether their child be kind of midway through, 10, 11 years old, just starting high school, or even a junior, senior in high school, getting ready for college. Have they, totally missed out on the benefits of a 529 plan? Roger, I'll let you go ahead and take this.
Sure. I would say it's never too late to start. I mean, you want to start earlier. You can certainly contribute when your kid's in high school, even in college. It's nice to have that money earmarked for college. There's something great about psychologically having that money in a dedicated account. I hear that all the time from people, just gave me comfort knowing, okay, I've put that specifically for college. And it's also a reason, to use a college savings account instead of other types of accounts. Now, you do give up on, the potential growth over time. You probably want to be more conservative with the investments if you're getting a later start closer to college. So you have, less growth potential. That also means that the tax benefits you're going to get probably aren't as great. So I don't want to say you absolutely have to do a 529 if you're getting a late start, but there are some nice things about it. Just don't assume it can do more for you than it can.
Yeah. Yep. The other piece out there is when you're at that late stage, like you said, it's never too early, but it can be too late. But going through earmarking, understand if your state does have a state income tax benefit, could be something to consider because, as Roger said, we're not going to be looking for great investment returns. We would rather preserve the capital, make sure it's there to pay the bill, and take a lot of risk in the market. But if your state does have a state income tax benefit, that could be a meaningful reason to put it there and make sure you're at least taking advantage of that to and through college.
Yeah, exactly. And I think that's a key point there through college, right? If you're paying a tuition bill anyway, it might be very beneficial for you if you got a state tax benefit to funnel that through a 529 plan. So I do think that's key to keep in mind there. So we'll move on to the next question here, and it's all about qualified expenses, right? A lot of people ask us, are the 529 plans only used for tuition? And and when we say no, there are other expenses that are qualified. A big question there is, well, how do I take out the money when the bill is not coming directly from the school? So I think, Joe, you'd be able to speak to that pretty effectively.
Yeah. So, I mean, when they look at the billable costs, you're going to say, what's the cost of attendance of the university? And then that's the amount that you could potentially take out pretty justifiably from your 529. So example would be if you're living off campus. That's probably the most common one. What if you're not living on campus or eating the food from campus? You can justify up to their room and board number very easily just by taking that out to yourself and then providing that using those dollars. That's kind of the easiest way, I think, to justify that. You can take it out up to that amount and justify it pretty easily, whatever they advertise in their cost of attendance. So does that answer the question? I think it's.
Yeah, that was great, Joe. I think we should make one clarification point, because there's always this question about transportation costs, right? That's the one kind of thing that shows up in the cost of attendance regularly, right? But that is not a qualified expense, unfortunately, with the 529 plan. So I think that's also important to answer there.
Yep.
Can't
buy a Porsche with the 529 plan.
One other thing that I would mention, though, is when we talk about room and board, 529 plan is somewhat unique in the world of tax benefits for college, in that room and board are allowable, whereas with some of the tax credits, for example, they're not. So it's 529 is fairly flexible.
Mm-hmm.
That's an excellent point there, Roger. So, Joe, I want to come back to you here because this is about talking about scholarships. What if your child earns a scholarship and otherwise admission to a U.S. Service Academy, or maybe doesn't decide to go to college at all, rather goes for an apprenticeship or something along those lines? Is a 529 a viable option for that?
I'll start with apprenticeship because it is now a qualified expense. Most of them, as long as they're accredited, you'd have to check with that body. But that was something that I think was part of the Secures Act that came out and said that, yes, apprenticeships are going to be covered. So I thought that was actually a great addition. So it could be a fully qualified distribution. Service academies, as well as scholarships. I think a lot of people overlook it, but if you do happen to get a scholarship, it's like a pseudo qualified distribution, because if you take a non-qualified distribution from the 529, what they're going to say is, here's your money back, here's what you contributed, and then here's what the investments did in growth. And on that growth, you're going to have to pay taxes as well as a 10% penalty, right? So if you put in 5,000 is worth 10, they take that 5,000, they say you're going to owe taxes and 10% penalty on that. The beauty of the scholarships is they say, we're going to give you your dollars back, and you are going to pay taxes, but you will avoid the 10% penalty. So you've got tax deferred growth on that. So all you do, there's no penalty. And you just got free money for college. So be happy with that and take it to the bank, is what I would say. So it's a nice provision. You don't have to pay taxes, but you avoid the penalty, which I think is great. I think it was Bush that signed that into law for those in the service academies, which I thought was pretty fantastic as well.
Excellent. There's a follow-up question here coming from the audience, and this is an interesting one. Do summer internships, right? Say if they're going somewhere else for the summer and they obviously need to cover some room costs there, is that something that they can distribute from their 529 plan? I'll leave that up open to either of you.
To me, probably no. And without some extenuating circumstances, I would say no. Those are choices, but I don't know if Roger has other insight. But I've always advised that to live when you have a job wouldn't count.
Yeah, I think the key is it's expenses while you're a full-time student, right? Or while you're a student. So yeah, the summer probably doesn't count. That I would agree.
Excellent. So if at this point somebody says, wow, 529 plan, very flexible, that's something that I'd like to use to save for my child, my grandchild's or other loved ones' college expenses, what should we be considering, when we're choosing a plan? And this is often framed as the in-state, or should I use an out-of-state plan? So Roger, what would you consider here?
The state tax benefits are a big consideration. Like Joe mentioned, that would be probably at or close to the top of the list. You'll certainly also want to look at what are the investment options. Are they things you like to use? A lot of plans are going to have somewhat similar age-based portfolios, as well as other investments like all stocks or all bonds or money market. But you'll look at and see what the performance track record is. You should look at the fees. Certainly fees are going to vary depending on how you do it, whether it's an advisor-based program or a direct sold program. And I think also looking at the customer service, to the extent you can look into that. Is the website easy to use? Can you reach people at the plan? Does the plan make it easy for you to have, grandparents or other people put in gifts? So a lot of considerations, but from a pure dollar standpoint, that state tax benefit might be the decider, to be honest with you.
Right. Joe, anything to add there?
The only thing would be if there's investment firms that you're familiar with, you like their funds, maybe you use them in your 401k at work retirement plan. T. Rowe Price would be a great example. If you're familiar with their lineup, there are plans that may mimic that. If you like Vanguard, or there's even fund, DFA, if you work with those type of funds. So if there's a fund family you like, you can probably find a 529 that can kind of give you pretty good options that you may be familiar with. So.
Yeah, and following up on this concept, I'd like to talk about investment options a little bit. There were a few questions during registration about should I have, firstly, comparing 529 plans to just owning stocks, or should I have my money in a 529 plan when I'm getting closer to my kids' college or in times of volatility? Or should I keep it in cash? And I think key point is you can do both. So maybe Roger, if you could speak a little bit more about the investment options, I think that'd be fantastic, so that people can understand kind of how that works.
Sure, and I'm seeing some questions come up about kind of the basics of the tax benefits. So maybe I'll cover that real quick first, so that we level set people. The basic benefit from a tax standpoint is you put the money in, you don't get a federal tax break at that time, but the earnings are tax deferred, and if you take the money out for qualified expenses, it's tax free. So you could think of it similarly to like a Roth IRA. You don't get the tax break up front, but you get the tax-free qualified expenses later. So that's a very nice tax break. You don't get that type of break if you just use a regular savings account or brokerage account. And obviously the purposes for which you can take the money out are different with a 529 or a Roth. Okay, so basic differences there. In terms of the investments, again, you can put it in age-based, which is very nice. I think there's some concern about, okay, as we get close to college, is it going to be too aggressive? Should I have any money in stocks at all? Typically, as you approach college, a lot of the age-based plans will have 20% or less in stocks, and you think, okay, some of that money is going to be for 4 years down the line. That's not unreasonable. But if you want to be more conservative, you can probably put it in, a bond fund or a money market fund or something like that. You are limited to 2 changes per year in investment strategy, but you can do investment changes gradually over time by changing what you're putting the money into on a monthly or quarterly basis. So still reasonable amount of flexibility. I've never felt too constrained by that 2 times per year limit. So yes, you can invest in a number of different things through the shell of a 529 plan structure.
Yep.
Excellent.
Yeah, I'll add go ahead, Mark.
No, please.
I was going to say, those age-based plans are really designed to help us have professional money managers design a portfolio that matches your risk tolerance with your time horizon. So when are you going to need the money? What's the appropriate mix of stocks and bonds, international, US, all those things. So all the things that you probably don't want to think about as an investor, there's professional investment firms that will do that for you and what they think is in your best interest to get you to have the highest probability of achieving your goals. So for a lot of people, if that's one of the things intimidating about getting started, those age-based plans, they really are designed to help you get started. And I don't want to say set it and forget it, because you always do want to review those, but that really is the idea. So take some of the intimidation out of it, the investment aspect, so that you really can feel comfortable. You've got a professionally designed portfolio built for you that gradually gets more conservative as you get closer to your goal. So one of the things I'll say is, just like any investment, you don't want to look at it too much, but you want to make sure you're reviewing. So with the college savings plan, I'd make sure you're at least looking at it quarterly for some, but annually is probably fine with younger kids. Because what I find when meeting with families, they have a 15, 16-year-old and they're still 90% stock. And I'm going, we're going to need that money, so, you're going to need that. So we'd rather not take that risk. We'd rather have that money there than, the last 6 months would be a good example. So just make sure you're not ignoring it and review it. But those age-based plans are designed to help us get hopefully to where we need to be without a whole lot of manual input. And as one client put it, I see it as it's like a crock pot. You got to look at it once in a while, but you don't want to touch it too much because it'll mess it up. So I kind of like that analogy.
Good one, Joe. Joe, I'd like to come back to you here because we've got a few questions about scholarships and some folks that are under the impression that if they start saving the 5 to 9 plan, their opportunity for scholarships in the future is going to be diminished. I know you've got a lot of data on scholarships and financial aid, so hopefully you'd be able to assuage those fears.
Yeah, I think don't let what you read about what you have saved, how that affects your scholarships. It's really what affect potentially your financial aid, which is a need-based aid. So scholarships are based on the merit of the student. And that's be that athletically, academically, arts, whatever. So scholarships are going to be based on that student's unique abilities, whereas your need-based financial aid, that could be impacted by the savings that you have. But it's kind of, there's two different schools of thought. So when you're looking at the financial aid process, they're looking at the academics of the student to determine scholarships. They're looking at your finance to determine your eligibility for need-based financial aid. And the thing that most people, as you get closer, you'll need to understand is what's the financial aid policy and the business model of that university. For example, some schools flat out don't award scholarships. And those would be schools like all of the Ivy League schools. So it doesn't matter what you do, where you save, you're not going to get a scholarship from those schools because they don't have them. If you're a need-based candidate, they absolutely have a lot of need-based aid. So there's a lot kind of wrapped up in that question, but where you save and how you save really shouldn't impact your scholarship opportunities.
Excellent.
One thing I'll add, if I could, in terms of the need-based portion, it's also important to remember that your income affects the need-based calculation a whole lot more than your assets do. Some of your assets are going to be excluded. Even some of your 529 assets could be excluded. And, adding $1 of, assets in a 529 plan only affects your expected contribution by at most, I think, 5.64%, whereas additional income can affect it by 33% or more. So you don't want to be in a position where you're overemphasizing the saving impact and your income has put you out of range for a lot of aid anyway. You don't want to be high income and low savings.
Yep. Yeah, that's a great point. It's like the most they want out of your savings is 5%, 5.64%. Like you'd rather have that and be assessed at 5.64% than not have it there. Trust me.
Excellent. And Roger, a lot of folks ask, if they've got multiple children or multiple grandchildren or even godchildren whom they're saving for, does it make more sense to open one plan for all of them or different plans for each of them? And what are your considerations there?
It's interesting. I've heard different opinions on this, even within financial planner community. And the argument for just one account is, it's simpler. You don't have a bunch of stuff to manage. I don't think it's particularly difficult to set up multiple accounts or to set up automatic payments into multiple accounts. I think by the time they get to college, you probably want to have them split anyway, in terms of having the different beneficiaries and having it kind of clean in terms of the money for your particular beneficiary going to the right person. It's also helpful if they're different ages to have the different age-based portfolios. So I would lean toward multiple accounts. Take the time now to get those set up. But if you're just getting started and you just want to set up one and split them out later, that's not a ridiculous approach. Joe, I'm curious your take on it, because I don't think there's necessarily a right or wrong answer.
Yeah, I'm a pretty big proponent of aligning the investment with the goal you're trying to reach. Because like you could have an 18-year-old, a 12-year-old, and a 6-year-old, and their investment time horizon is so different. And the appreciation potentially of those funds. Because like when we sit down with a family, we're going to try and figure out if you want them all to have the same pot of money when they get there. And it's also relative to, it might be $30,000 for the first one, but we might need $40,000 to cover it for that younger student because of the rising cost of tuition. And just simply the way you're invested, you don't want to be as aggressive with all of those. It should, in our opinion, align that with the goal that you're trying to reach, the time horizon, so that the portfolio is built the right way for that particular goal. And I think, Roger, you mentioned it earlier, just, earmarking it for that particular goal. When you've got 3, 4, 5 kids, what you do for one, you'd like to do for all. And the temptation would be, if you have it in one account and that kid gets into Yale, we're just going to blow it all. And that's not a great precedent to set. So I really like that idea. It kind of keeps people disciplined and allows you to fund it differently as well. So, you might need to put $100 into this one, $200 into this one, $250. So, using the calculators that are there and aligning the goals with each one's education is that'd be my preference.
Yep.
Thank you. And a follow-up question on this topic is, how difficult is it to change the beneficiary of a 529 plan? So there was a question here in the Q&A, and it's phrased as, can the 529 owner use the money for his or her own education? So maybe I'm saving for my children, or in my case, my children who are not born yet, and I decide I want to go to graduate school. So what is that process challenging? If maybe, Roger, you could speak a little bit to that.
It's interesting. I haven't done it. I don't get the sense that it's particularly difficult. I guess what the challenge might be, if you want to separate out some but not all of the money, you might need to set up a new account and do a transfer. But it all seems doable. And again, it comes back to work with a plan that has good customer service, and they can help you through it.
Mm-hmm. Yeah, we've found it to be pretty simple. Transferring from one sibling to another, even as much as a first cousin, and using it yourself. I had that question yesterday. We actually oversaved in 529s. I said, congratulations, you're very much in the minority to have actually oversaved. But looking at going back to get PhD, I said, yeah, absolutely, we can do it. It was pretty easy. So, and the flexibility on the back end, if you don't use all the funds, I don't know if we want to go down that rabbit hole, but they're just.
I think we do actually, Joe, because there have been some questions about what happens to that unused money.
Yeah, because in changing beneficiaries is one, you could go to yourself, but one of the things that we see, if people do have those dollars left over now, is what we call legacy 529. So we talk to them and they say, hey, your kids are 22. What if we put this in here 25 years from now? We've got a heck of a nest egg for your grandkids. It can grow tax-free. We can change that benefit. We don't even have to name that beneficiary right now. It can just grow tax-free, and make sure you have a successor owner that could be the parent, so that that they could take that over if that happens to be the case. So that's a big one. And then also the expansion to be able to utilize the funds to pay off up to $10,000 of student loans. That's a big one. Just recently it came about. So that flexibility, the legacy 529, changing the beneficiary. So a lot of flexibility. And in worst case, if you distribute the money, you've had good tax deferred growth and pay some taxes on it. But if college is paid for, it's not the worst thing. So that's a couple ideas.
K through 12 expenses now too, right? It's gotten even more flexible in the last few years.
Yeah, that's a great point on the K through 12, because if it's for grandkids and they're going to go to private K through 12, it could start as early as then to help them with that. So,
That's terrific. So a question that came in during registration was quite interesting, I thought, and it basically gets to, does the timing of withdrawals matter? So the registrant asked whether they could pay for the 4 years of college out of pocket and then reimburse themselves through the 529 plan. Maybe Joe, you could speak to that one.
So the expenses need to occur in the year that you make the distribution. That's the simple way to think about it. So in the calendar year, and that's kind of tricky because there's an academic year and a calendar year. So what you got to understand with the 529, it's the IRS regulating it. So whatever the expense is needs to fall in the same year that you're looking for a qualified distribution to fund that expense. So hopefully that's kind of a simple way to think about it, because sometimes you'll want to pay a bill in January. It's not due till January. If you want it to hit for the last year, you got to make sure the expense aligns with the qualified distribution for that tax year.
Excellent.
I will say just on that too, Mark, is like just the two ways that you can take a distribution is the one, you can have it sent directly from the 529 college savings plan to the university, which is actually a pretty nice way to do it. Keeps it pretty simple. It's a little more complex if you say, you know what, send us the check, we'll keep the expenses. And we're going to use those dollars, but you need to make sure that you keep record of what those expenses were in that year, in the case of if there were to be an audit or something like that. So that just kind of rounds out that question.
Thank you. And there was a clarification here in the Q&A. Can the 529s be used to pay off education debt, student debt? And that is now the case. There is a $10,000 lifetime limit, however. So you'll definitely want to keep that in mind. So moving forward here, this is a question we've seen a few times now in the Q&A. It's really terrific, I think, that grandparents are saving for their grandchildren and even other young loved ones. I saw somebody who's a godparent saving for their godchildren. That's really fantastic. I know my grandparents made a really huge impact on my ability to pay for school. So, I'm very grateful for that. But there are, some concerns about tax and financial aid consequences with the 529 plan. So maybe Roger, you'd be able to speak to that a little bit.
Sure, and I think this is a key one in that things are changing going forward a little bit. So historically, if a grandparent has, a grandparent-owned 529 and uses that money for the child's college, that money that as it gets used is considered income to the student. And for financial aid purposes, that is not ideal, okay? So some people will work around that by, waiting until like the last year of college to make that, to use that money from the grandparents' account so that it's no longer affecting future, FAFSAs. An easier way is to have that money go, instead of into a grandparent-owned plan, into a parent-owned plan. But, there are various considerations, and one of them is control, right? As a grandparent, do you want to maintain the control of that, or do you trust, your child, the parent of the student, to manage that? So, there are also people who aren't worried so much about the financial aid implications. So it does really depend on your individual situation. You want to be careful about the financial aid potentially, though. Going forward, and then maybe I'll let Joe talk about the details here, but in a future year, the FAFSA is going to get simplified, and you'll no longer have to report that income from a grandparent. So Joe, maybe you can fill in details on that.
Yeah, it'll be a pretty big change in that we've always kind of had to navigate around if grandparent or really anybody, we tend to say grandparent, but it's really, if it was a godparent, I think was specifically in the question, anything that wasn't reported on the financial aid forms that came in, they were going to ding that as, hey, that wasn't reported, so we're going to count it as income to the student, untaxed income. But going forward, what they're saying is that's no longer going to be the case effective 24-25. And what they're looking at is the prior tax year. So to make it even more confusing, they're looking at the tax year of 2022, so 2022. Really this is the first tax year that could be impacted because of the way financial aid works. So it's a little bit of a rabbit hole to go down, but this is from a planning perspective. If you're working with an advisor or doing it on your own, understand that some of these financial aid implications of the FAFSA Simplification Act for divorced families, for I call it tri-generational planning, where you've got grandparent money, and sibling overlap. There are some big changes coming that are going to impact your family, to be aware of. And I know we've got stuff going up on the future of financial aid through the Saving for College, and what that's going to mean. But the 529, to Roger's point on, just that big impact, understanding it may be worth considering, like you said, trust, and do we trust them? But if you have dollars in the grandparent 529s and they're not going to count against you, anybody can put money into the 529. So even if the grandparent owned it, the mom and dad could still put in $100 or $200 a month or whatever they wanted, and have that pot of money, for junior when they go to school. So that's an important part. And we were kind of getting there, I think, of if you have a 529, anybody can put money in there. It takes a village to pay for college now. So understand, and Roger mentioned the flexibilities. Do they allow for that? Do they facilitate that, make it easy? And the fact that I think they've gotten a lot better at that, but there's a lot of potential there for planning opportunities with that.
Excellent. And there's a follow-up question here about when that simplification is going into effect, Joe. I know it's a little bit up in the air, but I guess, at a high level, like for younger families, maybe less of an issue.
Yep. So the first year will really hit us will be next fall, when we're applying for 24-25 financial aid. So that's really the October of 23 will be the first year we apply for with new rules and the student aid index, all that good stuff, effective for the 24-25 school year.
Great. So the next question is about contribution limits, right? So there's a specific question: can we put $30,000 at once in a 529? Maybe Roger, you'd like to speak to super funding and what the gift tax allows, et cetera.
Yep. Yeah. So, if you want to keep your life simple and not have to deal with, gift tax returns and all of that type of stuff, you would probably want to stick to the limit of your gift exemption in a year, and that's $16,000 per donor per beneficiary. Okay. You can also do this 5-year averaging. So you take that 16,000, multiply it by 5 years, and you could put in $80,000 now, and that'll count for the next 5 years worth of contributions. And then that is all without, gift tax, without having to count against your, lifetime limit or your generation skipping, any of that type of stuff. And let's face it, for the vast majority of people out there, that's going to be probably more than you can afford to put into a 529, and probably as much as you would want. But that said, the plans themselves typically don't have limits on what you can put in a year. They have lifetime limits that are imposed, because of the IRS not wanting you to oversave for what you could conceivably spend for college. So you could put more in and do it with gift tax return. Again, I think that's a good problem to have. Not too many people, kind of like the number of people, Joe, you're saying that end up with extra money. You don't hear that too often. So.
Yep. Yeah, and I think like just some of it varies by state, because the states do have these 529 plans, but around 300,000 is roughly what you see as far as the max that they'll let you contribute. Doesn't mean that's the max you can have in them. That's the max you could contribute over the lifetime is a typical amount, but it does vary state by state.
And there's a follow-up question here, guys. Is it $16,000 per year for one parent to one child? Can I put $16,000 per year for 2 children?
Per donor, per beneficiary. So, and as an example, husband and wife have 2 kids. They could put in 16. Father could put in 16 for one kid, 16 for another kid. Mom could put in 16 for one, 16 for another. So you could have 16,000 times 4 in that situation. So that's, again, that's a lot of money to put into into 529s in a year. Mm-hmm. And we also get questions of, how much is too much to put in? And, mm-hmm. and you don't want to put yourself in a position where you're ultimately penalized on that money. So at some point you might back off and use other things like just a standard brokerage account. But, again, most people don't have that problem of putting too much in.
So I'd like to rewind a little bit here. We've talked a lot about some of the more complex topics and how fantastic these vehicles are to save. But how do I open one? Do I need to go to my bank? Should I call my broker? Maybe if we can go, to the very basics, Roger.
Yeah, I mean, I think if you go online and search for, your state and 529, you'll probably pretty quickly find, who the company is that is used for that state. Typically fairly easy links to start the process of opening up an account. It needs to be done with cash. I think we've seen questions of, can you donate appreciated stock or whatever to fund an account? The short answer, no. You probably link it to a bank account to have money go in automatically. I'd say that part of it is hopefully a lot more straightforward than it used to be. You'll get a lot of documentation about the investment options, but you can choose a very simple one like age-based. You can set up an automatic payment into it. So they're trying to make it as easy as possible. In terms of comparing different plans, I'll give a plug to Saving for College, right? Lots of resources in terms of comparing the different plans and pros and cons and different considerations whether you're in that state or not. So don't be intimidated, I guess the short answer. There are ways to get through it without a lot of complexity.
Yep.
Excellent.
Yep.
Yeah,
Started.
I did drop the link to Saving for Colleges. We've got a map basically when you click there, so you can just click on your state and see what plans are available and research the investment options, tax benefits, et cetera, and go ahead and enroll right from there. But
Yep.
Joe, you had something you wanted to mention there.
Yeah, I was going to say, just getting started, life changes. So if you do change states, there is the ability you can move from one to another. If you choose, you could leave your balance where it is. You could start contributing to another. There's a lot of flexibility with them. And just as getting them set up, it can be as little as $25 a month or something like that, getting it deposited. And then for most young families, if you can just commit to doing something small to start, one of the strategies that I want to make sure I mentioned was this idea of stair stepping. So when you're younger, maybe you have your own student loan debt. One of the first generation of people that have their own student loan debt well into their kids' teen years. So kind of shrinks your ability to save in a lot of cases. But if you can start with, say, $25 a month, and then every time you get a raise, do another $25 a month. So just like you raise your 401k contribution, raise that 529 contribution. And you'd be amazed what that does by the time they're 18 and going off to school. If you're raising it by $25 a month, well, all of a sudden, even with those little increments, now you're saving $300, $400, $500 a month into the 529. So, don't think, elephant a bite at a time. Start small, but if you start when they're young, the compounding values of the money, and then just when you get that raise, just crank it up by $25, $30 more a month, and you'll be amazed what that does for you.
Thank you, Joe.
Mm-hmm.
So the next question, we've had a few of these types of questions related to international schools or even study abroad programs, and whether 529 money can be used at some of those international schools. I'm going to go ahead and drop a link here in the chat to our lookup of eligible institutions, right, based on the federal school codes. But maybe Joe, if you could speak to some of those issues as well.
Yeah, I mean, for the most part, the 529, the rules read that, if it's an accredited institution of higher education, you can use those funds there. So, I mean, that's pretty much, and that's global. I mean, these include things like culinary schools and now apprenticeships and, all around the world. So that is one of the great parts. So if they're looking at doing study abroad, there's a high likelihood that you'll be able to utilize it, as well as people have questions on what about student aid? Can you use that when you're going to international school? And typically, yes, because it's usually attached back to the university in the United States anyway. So it's pretty darn flexible around the globe.
Excellent, thank you. There's a question here. Can we discuss a little bit about 529 fund ownership? Specifically, what happens if the adult owner dies or refuses the child the access? Maybe Roger, you can speak to the control elements there.
I mean, generally, when you set one up, you have a successor owner. So I think that's really the key. Then if if say, for example, one parent dies, it typically goes to another parent. You'd want to then set up a new successor. So yeah, I don't want to get into kind of the details of estate management with it, but having that successor owner handles, I think, the vast majority of issues. And again, there's the owner versus the beneficiary, and again, you can change the owner, you can also change the beneficiary. Both of those are doable, and again, rely on your plan to help you through those changes if they're necessary.
Mm-hmm.
Thank you. I'm just looking through the Q&A here. I did want to ask about any limitations on how many plans you can open or who can open them, and anything around that. I'll go ahead and speak to that one a little bit, just because we've got a funny story of savingforcollege.com and its founding. Our founder, Joe Hurley, who is a CPA, opened up a 529 plan in just about every single state for his children so that he could research the different 529 plans. So there really aren't too many restrictions on that sort of thing. I don't know if you gentlemen have anything to comment there.
No, I've heard the Joe Hurley story, because back then you had to sign up and get the paperwork in the mail and get the prospectuses for everything and read through them and see what the fees were. And I mean, he was putting it together. I mean, that was, yeah, and here we are. So
I guess there's a difference between possible and advisable, though, right?
Oh, yeah, that's good.
Yeah, you want to keep your life a little bit simpler than having too many accounts out there.
Yeah.
But yeah, you can do a lot of accounts if you need to. Actually, another interesting story is the way the law was written in Maryland, where I live. Initially, people were kind of getting around limits on the state tax deduction by opening up tons of accounts, and then that loophole got closed. So I would just say if a loophole looks too good to be true, it's probably going to get closed, and think about the spirit of the law.
There is actually a question here about whether, as these laws change, whether you get grandfathered in or if you need to, act within the new law, if you will. Maybe you could clarify that for folks.
To me, one of the challenges can be, the federal government changes something and then the states take some time to catch up. So, the laws hopefully make it clear whether things are grandfathered or not. But yeah, you do want to be a little bit careful about the different state laws before you do take advantage of something new, like the K through 12 eligibility with federal. It took some time for the states, and I think they generally have caught up to it. The other thing is you do want to be a little careful about, if you take advantage of a state benefit and then you move the money, there could be some clawback of tax breaks and that type of thing. So you do want to be aware of the state laws can be a little bit more complicated. Joe, anything you'd add?
No, it's just kind of fundamentally they're a tuition trust authority of the state, and they're administered by the state. So to your point, like of when the federal says, here's what we're going to do, here's the 529. Well, sometimes these offices aren't very big and they maybe only have a few people, and they've got to figure out how they're going to actually administer and make sure and do these distributions in the right way. And so it may be some 3 months, maybe 6 months, maybe a year, but before you take a distribution, the K through 12 is a great example. Before you do that, verify that your 529, you can do that. Other things where those complexities come up are transfer of ownership of the 529. Some are much more liberal with how you can do that than others. So, those type of things, you want to make sure you're speaking with the 529, that your 529 plan administration team directly, if you're doing anything complicated like that. So, and they're usually pretty good at the customer service.
Great.
One other thing I'll just add real quick on the tax front, and you get questions about how difficult is this tax wise. In general, if you pay a college bill and then you take the money out of the 529 And so you're being very careful that you're not taking too much out. It shouldn't be that complicated for your taxes. I will say, personally, I've got 3 kids, all of them either through or in school. It's been the more complicated part of my tax return prep over the last few years because, there's coordination with the different credits, and the schools might do their 1099-T slightly differently from each other, and, tax software might not do it the way you hope. So you just have to pay attention to detail and get help if you need it, is how I would characterize it. Go to a professional tax person, even if you haven't had to in the past, if you're at all worried about messing up on the tax front.
Terrific, thank you. There's been a couple questions about foreign donors to your 529. So maybe you've got grandparents overseas or other friends or family members. Is there the opportunity for them to contribute to a 529? I'll leave that one open to either of you who might want to answer it.
I'm trying to think of what would go into that. I mean, honestly, if they have an American account, it's not a problem. That would be the one thing if they have accounts that are domiciled in the U.S.
Okay.
Yeah, bringing money into a financial institution in the United States, it's what the country it's coming from and the country it's coming into. There is no one uniform law, I don't think, if it's a bank in another country. So, Roger, I don't know if you know otherwise, but that would be my general. Be careful.
I'm just saying, Joe, thank you for taking that one. I don't want to give people the impression that these accounts are super complex, right? I think that's a recurring theme here. It's not hard to get started. It's not hard to put money in, take money out. In most cases, yes, there are going to be these quirks and things to deal with. But again, for most people, you don't let it intimidate you into not getting started.
Yeah. Yeah, I don't want to get into anti-money laundering rules on a 529 webinar.
Yeah.
So yeah, that'll be one that you may want to consult your professional advice.
Don't launder money. That'll be what we say, right?
Okay.
Anyway.
There's a question here as it relates to student loans, which is really interesting. Maybe Joe, you'd be able to help out a little bit on this one. It's pretty complex, but how is the 529 viewed as it relates to like income-based repayment plans? You mentioned that this is the first generation where you're dealing with student loans as well as saving for college. So somebody's balancing that, and they're trying to keep themselves on those income-based repayment plans or such. Do those 529 assets generally cause any issues there?
To my knowledge, no. It's really just based on income. So income-based repayment, they're not really going to look at assets as part of that calculation because they're looking at your tax forms. They're not really looking at your balance sheet. That's what I would, in general, they're not looking at the balance sheet. They're just looking at your income. So it shouldn't impact it.
I hadn't thought of it, but I would agree. That makes sense to me.
And sort of a related area here, I'd love to just help people understand a little bit about the withdrawal process and how that needs to be reported on the tax return and what kind of forms they will receive from the school. And I don't know which of you might like to dig into
Roger's
that.
in the mix. Roger's in the mix of it right now personally, so he can probably tell you first.
Yeah. So I'm getting my 1099-T form from the colleges, saying what we paid to them and as scholarship money. I'm getting the 1099-Q, I think it is, from the 529 plans in terms of what I've taken out, and I'm putting that into tax software and making sure that it doesn't say that I owe taxes on that, because I know I'm staying within the qualified expenses. So ultimately, what might show up on your tax return might be nothing at all. But in terms of the preparation, you need to take these forms in or download them or get them in the mail, whichever way you're getting them, and make sure that those are put into your tax software if you do it yourself, or given to your tax preparer to make sure everything works out properly.
Mm-hmm. Yeah, I mean, there's the forms, and then the mechanics. When you take a distribution, just so you understand, it's always pro rata. meaning that it's always what's the proportion of what you contributed versus what's the growth. If it's all qualified, there's no issue there because there's no tax on anything. But if there's some non-qualified distribution, it's always what did you put in, what percentage versus what is the growth. And where one thing that I was thinking as you were saying that, Roger, was if you are eligible for the American Opportunity Tax Credit, you want to be conscious of how that may be impacted in 529 plan because there are ways to do some calculations, but in general, if you can use non-529 you will use up to $4,000 to make sure you get the full American Opportunity Tax Credit. That's the general thing I would advise. But I don't want to go too down a rabbit hole on that, but it's just something to be aware of when you're thinking about how distributions can impact your overall situation.
Yeah, I think it's helpful to remind people, yeah, you can't double dip and count different expenses for different things, and that credit's a key one.
Yeah.
And yes, and that's part of the complexity in your tax return. Now, some people don't qualify for that, their income's too high. But if you are in the position where you have, an income that could qualify and you have multiple ways of paying, yes, I saw one of the questions we got was, do I use an, UTMA first or 529 first? And it really depends on your situation. You might want to do some of each, take advantage of those credits.
Yep. That's actually where I'd like to go next, Roger, is, we've talked a lot about 529 plans. Of course, it is 529 day coming up, but there are other options in terms of savings account. There are also, different styles of 529 plan, including prepaid tuition plans. So maybe we could just do a brief compare and contrast of those different vehicles here as we wrap up.
Sure, I think that makes a lot of sense. People talk about the custodial accounts, UTMA and UGMA, and those have some advantages in terms of flexibility. You can use it for other things if the child doesn't go to college without penalty. But there are some costs. It can be less tax efficient. You lose control over that money at the age of majority. So if you're concerned about your child, buying a motorcycle with it at age 18 or 21, the 529, you control more. For financial aid purposes, an UTMA or UGMA is a child's asset, and that's not favorable for financial aid. So a number of factors there. Again, not to say an UGMA or UTMA is bad, but for college, a 529 tends to be better. Similarly, people sometimes say, well, why can't I just use my Roth IRA? And you could, and you don't get penalized on that if you use it for education. But to me, you want your Roth IRA growing for years and years for your retirement. You want to take care of your retirement, like Joe said earlier. Take care of that first, and so you have this other option of a 529 that is specifically for college. Maybe you don't want to save up to 90, 100% of sticker price in a 529. You want to use mix it up and use a standard brokerage account for some of that money for the flexibility. That's great. But for kind of the basic expenses that you're pretty confident you're going to use for college for somebody sometime, child, sibling, grandchild, yourself, that's really what 529s are great for. So hopefully that covers a lot of the difference. I guess there's also the prepaid plans versus savings plans. I tend to like the savings plans, take advantage of potential growth in the market. Prepaid plans are really good if or are pretty confident that you're going to want to attend school in your current state. Then that benefit is nice that you lock in tuition dollars.
Mm-hmm. Yep. Yeah, I think there's a lot in there. I love the point about if you have the ability to save towards 100% of the cost, you might not want to save all of that in a 529. Just a brokerage account or something outside that's more flexible that you could use for something like buying a car. Because maybe that's something, if you have that ability, those are other expenses that will come. So if those are the kind of things you also want to make sure you have dollars for, save for about 50 to 60% of the cost in a 529, and then the rest maybe contribute to joint brokerage. And then the private college 529 is a prepaid tuition plan that I think is a really unique tool that if people haven't seen it, check it out. There are restrictions on it and what schools you can utilize it for, but for some, it's kind of an interesting option to consider as well.
Thank you, Joe. Unfortunately, we're about out of time for today, but special thanks to our panelists, Roger and Joe, and their organizations, T. Rowe Price and College Aid Pro, for taking the time today. And thank you all for your great questions and for spending the time necessary to learn about some of these complex topics. Hopefully we were able to answer many of your questions. If you do still have questions, go check out our resources at savingforcollege.com. And your loved ones are going to have a better future because of the action that you're taking today, and we really applaud that. If you're the parent of an older child, we invite you to join myself, Joe, as well as another panelist on June 21st as we discuss student loans. So more details will be to come on that event. Cheers, everyone. Have a wonderful day.
Thanks, Mark. Thanks, Roger. Cheers.
Thank you.